Hello, and welcome to Donut Investment. This analysis is for Powell Industries on NASDAQ as of 31st of July 2026, with a share price of $213. The full report is on donutcn.ca. A small-cap electrical infrastructure winner riding a powerful capex supercycle. Business quality 80, driver 76, a record $1.8 billion backlog, debt-free, whose stock is now richly valued after a big run. 41.6 times earnings versus a 22.5 times warranted multiple. All three horizons hold. Great exposure, wait for a better price. Don't chase it here. Start with the business, because it is a good one. Powell Industries builds custom electrical switchgear and power control systems, the ruggedized backbone that distributes electricity inside refineries, LNG terminals, utilities, and, increasingly, hyperscale data centers. It is a niche integrator, not a giant, about $1.1 billion of revenue against electrical majors like Eaton, ABB, and Schneider. But the quality is real. It runs debt-free, $545 million of cash against $2 million of debt, earns a return on equity near 30%, and sits on a record $1.8 billion backlog, up 33%, with a book-to-bill of 1.7. That earns a business quality score of 80. The company has never been the debate. Now the tailwind, because it is genuine. Powell sits directly in the path of three of the decade's biggest capital spending themes at once: grid electrification, the data center power build-out, and LNG and energy infrastructure. You can see it in the orders, bookings up 97% year-on-year, a record quarter of $490 million, and a post-quarter data center mega award of more than $400 million on its own. The macro read agrees. The 30 July macro driver rates industrials outperform now and strong. Outperform on the long horizon. That lifts the driver score to 76, a clear tailwind. But a tailwind is a context pillar. It can only amplify a buy, it cannot rescue a hold, and this is a hold. Here is the catch, and it is the whole story. Powell trades at 41.6 times trailing earnings, about 1.85 times the 22.5 times multiple the fundamentals warrant, and comfortably above the 23 times guardrail for an industrial. On its own 5-year history, the stock is in its top decile, near the richest it has ever been, on a free cash flow yield of roughly 2%. The reverse DCF is blunt. At this price, the market is implying about 18% sustained earnings growth, when our disciplined estimate is nearer 10. Valuation scores just 35, and that trips the valuation ceiling. A triggered hard gate that caps the signal at hold across all three horizons, no growth exception. Great business, wrong price. The risks here weigh at least as loudly as the tailwind, and they all trace back to the price. First, valuation itself. After a big run, the stock leaves no margin of safety, and the bear case is a D-rating of about 30% to $150, a multiple compressing from 40 plus toward a still full 25 times, regardless of decent near-term earnings. Second, cyclicality. This is a project business tied to oil and gas, LNG and data center capex budgets, so a slowdown in any of them hits both the order book and the premium multiple at once, and a competitive push from the electrical majors into data center switchgear would compound it. Third, small cap volatility. The stock has already had a roughly 35% drawdown and fell 8.3% on the 28th of July, and Q3 earnings on the 3rd of August are a binary event into the print. Against all that, the downside is cushioned, debt-free, a record backlog, and analysts still around 48% above the price to a $316 consensus. Now weigh the risk against the reward. The bull case is roughly 43% above today, the base case the most likely about 5%, and the bear case a fall of about 30%. So you are risking about 30 to make 43. So, our call on Powell Industries, on NASDAQ, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donut Investment at donutcn.ca. The link to the full report is in the notes below. Have a great day.